Markets rallied again after a slew of executive orders were announced this week. Markets followed up last week's rally with more of the same as the S&P finishes up 1.7% for the week. It was a short week with MLK on Monday, which was also the presidential inauguration. Markets were cautiously optimistic leading into it. They were definitely hopeful for a more favorable business environment, but slightly hesitant on certain issues like tariffs. The market optimism increased as the steady stream of executive orders and announcements were made. So let's dig in. First, tariffs. Planned tariffs were announced with Canada and Mexico at 25% and China at a lower 10% starting in February. However, with all three not effective immediately, the market has hopes for negotiations to take place before anything is official. This was definitely a positive for markets expecting harsher terms. Second, AI. Stargate was announced to fund AI infrastructure with an initial 100 billion investment and over 500 billion over the next 4 years. We saw AI names lift on the announcement as the infrastructure spend train continues to roll. It was a faucet of executive orders, but a majority of the policies has less of an impact on the economy. However, there's still a couple of issues we're monitoring. One, energy. Oil pricing fell during the week with potential for more US drilling as well as a call for more supply. And immigration. Unsurprisingly, there's a big focus on limiting and enforcing immigration rules. We could see labor shortages in immigrant heavy industries like agriculture, which also may impact inflation in the future. However, markets on the whole celebrated the announcements, but we'll see how things play out once the initial euphoria dies down. So what's next? Next week is another Fed meeting, and focus again likely turns towards rate cuts. We expect the Fed to hold the line and communicate that to the markets. With a big run up into the meeting, we'll see how stocks hold up with the Fed likely confirming rate cuts are on pause.